Gold is often referred to as a hedge against inflation, but discerning investors want to understand why that is the case. Before making an investment in precious metals, they want to understand, how does gold hedge against inflation? We're going to answer that question in this short video. If you are concerned about your retirement savings and how they will be affected by inflation, I have a very interesting chart to show you demonstrating that gold responds to inflation after a time delay. Now, I'm working with some new video production software and I'm not very good at it, so please bear with me in this video. To set the context for this discussion, let's assume that Milton Friedman is correct and the only cause of inflation is an overproduction of the money supply. When central banks print money faster than the economy is growing, the value or purchasing power of each monetary unit is reduced. It takes more of these watered-down monetary units to purchase the same amount of goods and services, and we describe this phenomena as inflation. Now understand, the value of gold is constant. 1 ounce of gold is always worth exactly 1 ounce of gold. The price of gold, however, increases during inflation because it takes more of the watered-down monetary units to purchase the same amount of value. That's the gold and inflation relationship in a nutshell. Silver, gold, and real estate are the most common hedges against inflation. Commodities and TIPS bonds are also inflation hedges, but most people are unfamiliar with these investment vehicles. Hedging against inflation is really about protecting the value of our hard-earned savings over time. Our money had a certain value when we earned it, and we want it to have at least the same amount of value in the future. By hedging our investment portfolio, we are attempting to create a safety net that preserves the purchasing power of our money. The best hedges against inflation provide this safety while also reducing our exposure to counterparty risk. Counterparty risk is the probability that a company will default on their contractual obligations, causing the value of their stocks and bonds to drop, potentially to zero. An example of this is Enron stock in 2001. As it became widely known that the company was riddled with fraud, the stock dropped rapidly from $90 per share to well under $1 per share. Physical precious metals have zero counterparty risk, and they are one of the very few asset classes that can make this claim. When we use physical gold and silver to hedge our portfolio against inflation, we also reduce our portfolio's exposure to risk. That is why physical precious metals are the absolute best hedge against inflation. Silver and gold demonstrated their hedging capability during the pervasive and wide-ranging inflation of the 1970s. Gold rose from $35 an ounce to $850 an ounce, while the price of silver increased from under $2 to almost $50 an ounce. The performance of these precious metals during the 1970s is the best example of hedging against inflation we can study. Bond investors got decimated during the 1970s. This chart shows rising interest rates, but keep in mind that bond prices move inversely to bond yields. Bond prices can be confusing, so let's take a moment to clarify why the price of a bond declines as interest rates rise. Let's say you buy a bond today that pays a 5% yield, and tomorrow interest rates rise to 6%. You decide to sell your 5% bond, but your potential buyer says to you, "Why would I buy your 5% bond when I can buy all of the 6% bonds that I want?" In order to sell your 5% bond, you have to sell it at a discount, i.e., the price goes down. This chart shows what happened to bond prices as interest rates climbed during the 1970s. Buy and hold stock investors did better than bond investors, unless, of course, they were invested in the stocks of numerous companies that failed outright due to inflation. Stock investors also had to sit through a 50% downturn in 1973 and 1974. Notice that stock investors by 1974 could have been back to zero or even underwater on their initial investment. Claiming that gold is always an inflation hedge would be a lie, because on a short-term basis, that claim simply isn't true. Look at the price of gasoline over the past 2 years. It now costs twice as much to fill up our cars and trucks, but the price of gold has only increased by 25%. On a short-term basis, calling gold an inflation hedge is a myth. When we look at longer time frames, however, gold definitely preserves purchasing power despite the ravages of inflation. Consider a bespoke or hand-tailored suit from the 1920s. An ounce of gold in 1920 was worth $20, and a hand-tailored wool suit could be purchased for $25 or less. Today, gold is worth about $1,800 an ounce, and that is far more than the cost of a hand-tailored Armani suit. Automobiles are another example of gold's long-term inflation hedging abilities. In 1925, a Ford Model T could be purchased for $300, which equaled about 15 ounces of gold. Those 15 ounces of gold today are worth about $27,000, which gives us more than enough money to purchase an entry-level sedan or even a low-end luxury sedan. Clearly, gold acts as an inflation hedge over long periods of time. The real value of gold as a hedge against stock market risk comes from the fact that physical gold has zero counterparty risk. Inflation is currently collapsing corporate profit margins as input costs rise and consumers pump the brakes on discretionary spending. Some of these companies will not survive the current market carnage, and investors holding the stocks and bonds of these companies will lose 100% of their investment. Investors who hold physical precious metals, on the other hand, will be completely unaffected by these corporate collapses. It doesn't matter how many businesses fail, an ounce of gold is always worth exactly 1 ounce of gold. And the price of gold never falls to zero in any currency ever. This chart of gold versus inflation during the 1970s demonstrates that increases in the price of gold tend to lag inflation by months or even years. Now, some analysts might argue that gold's price increase in 1971 was caused by Nixon closing the gold window, but let's remember why our president did that. Because of inflation, France and America's other trade partners decided that they wanted payment in physical gold instead of the US dollar. As the U.S. stockpiles of gold began to dwindle, Nixon closed the gold window to stop the bleeding. In 1973, the petrodollar agreement with Saudi Arabia was finalized and gold completely disconnected from the U.S. dollar. This time-delayed effect suggests that the price of gold today has yet to react to the massive inflation of the last 2 years. Analysts at Goldman Sachs are currently predicting that gold will hit $2,500 an ounce before the end of 2022. Identifying the best performing asset classes from 2021 may help us find a hedging strategy for 2022. Note that all of the assets listed here have counterparty risk with the exception of fine art, real estate, and gold. Obviously, crypto was the place to be in 2021 for outright capital gains. But crypto, at best, is a speculation, not an investment, and certainly not an inflation hedge. Gold pulled back a little bit in 2021, but keep in mind that gold's response to inflation occurs after a time delay. Overall, real estate was the best inflation hedge in 2021. When you realize that physical gold is the best inflation hedge available today, you have two options. One, you can buy physical gold with after-tax money and store the metal where it is readily accessible, or two, you can transfer some or all of your tax-advantaged savings into a precious metals IRA. Find out how by clicking the link below.